Welcome to The Explainer. Today, we're going to dig into a forgotten market crash, one that has some pretty unnerving parallels to what's happening in the market right now. So, is history about to repeat itself? Let's get into it. Okay, so let's kick things off with a classic warning from the legendary investor Sir John Templeton. These four little words, this time it's different. They're a trap. It's the kind of blind optimism that fuels market bubbles, and that idea is really at the heart of the story we're about to unpack. All right, so when I say market bubble, what pops into your head? Probably the dot-com bust, right? Or maybe the 2008 financial crisis. But here's the thing. There's another one, a forgotten bubble that has this almost spooky resemblance to today's market. And its collapse, it was absolutely devastating. Yup, we are talking about the Nifty 50 bubble of the early 1970s. It was a time of just incredible confidence that, well, it ended in a painful, decade-long hangover. But before we get into why it all went so wrong, let's just take a look at how bad the damage really was. Wow, I mean, when this bubble popped, the fallout was just brutal. The entire market got sliced in half. We're talking about the world's biggest, most beloved companies just seeing their value evaporate. Inflation went through the roof. And this wasn't some quick dip, no. It took investors nearly a decade to claw their way back. So the big question is, how on earth did things get to this point? Okay, so the story really kicks off in an era of just pure, unshakable confidence in the American economy. There was this belief that took hold, this idea that certain companies were basically invincible, and that gave rise to a whole new way of thinking about investing. I mean, think about it. After World War II, the US was just on fire, economically speaking, an absolute sugar high. Factories were pumping things out, suburbs were exploding, and by 1970, the stock market had delivered these incredible returns for 25 straight years. Can you imagine? This long stretch of pure prosperity created this powerful feeling that the good times were never ever going to end. So, all that optimism led to this new idea. They called them one-decision stocks. The concept was super simple. Find the most dominant, powerful companies out there, and just buy them. That's it. The second decision, when to sell, that was seen as totally unnecessary. The idea was you just hold them forever. And this group of about 50 stocks became famously known as the Nifty 50. And just look at some of these names. We're not talking about risky little startups here. These were the blue-chip household brands that everybody knew and trusted. I mean, Coca-Cola, McDonald's. These felt like the absolute safest bet you could possibly make. They were seen as completely bulletproof. But, here's the catch with that whole one-decision philosophy. When everyone believes you should never ever sell, what happens to prices? They can get completely detached from reality. And that exact mindset created this massive valuation bubble. One that was just sitting there, waiting to pop. Okay, so this slide really puts it in black and white. Now, the PE ratio is just a simple way to measure how expensive a stock is compared to its profits. At the time, the wider market was trading at a pretty reasonable 15 times its earnings. But the Nifty 50 stocks, on average, they were trading at a jaw-dropping 42 times earnings. That's nearly 3 times more expensive. And if you drill down, some of the individual numbers were just in another galaxy. McDonald's was trading at 86 times its earnings. Polaroid was at 90. I mean, to justify these kinds of prices, you had to believe these companies would grow perfectly, forever, without a single hiccup. It's just not realistic. And this chart, this really drives home just how lopsided the market had gotten. Think about it. Just 50 companies made up around 45% of the entire US stock market. Basically, the fate of the whole market was resting on the shoulders of this handful of super overpriced stocks. And then, boom, reality came crashing in. A whole series of macroeconomic dominoes started to fall. You had an oil crisis, inflation just surged, unemployment shot up, and it completely shattered that illusion of stability. The market came plummeting down in what was at the time the worst bear market since the Great Depression. Yeah, and if you were hoping for a quick bounce back, you were out of luck. The recovery was anything but quick. It took 8 long years for the market just to get back to where it was before the crash. Can you imagine? That's 8 years of zero returns for anyone who bought near the top. So, if this whole story of beloved, invincible companies with sky-high valuations and a super top-heavy market is starting to give you a little déjà vu, well, you're picking up on exactly what Mark Twain was talking about. So let's see how this historical echo is playing out right now in today's market.
Right, so fast forward to today, and we've got a new cast of characters playing a very, very similar role to the Nifty 50. We call them the Magnificent Seven. And yeah, they are the absolute titans of our modern economy.
Look, the story is basically the same, just with a new cast. Back in the 70s, you had this group of trusted, blue-chip companies that investors were convinced they could just buy and forget about. Today, it's a group of world-changing tech giants that seem every bit as dominant and every bit as invincible. And the concentration of power, it's just as striking. Back then, you had about 50 stocks making up 45% of the market. Today, it's just 7 companies that account for around 36% of the S&P 500. It's wild. A huge chunk of the market's entire performance is once again being driven by just a tiny handful of stocks. So, what about their valuations? You guessed it. Just like their 1970s counterparts, they are priced for absolute perfection. And these aren't just numbers on a screen. They represent these massive, massive expectations for future growth. You've got PE ratios in the 30s, 40s, 50s. That's way above the market average, which tells you investors are expecting flawless performance. And then you've got Tesla, which is just on a level that defies all the traditional rulebooks. By any historical standard, these are not cheap stocks. And this brings us right back to the beginning, doesn't it? It's easy to see how we get here. You've got a bit of recency bias. I mean, these stocks have done so well for so long. And you've got a serious case of FOMO, fear of missing out. But you have to ask, are investors today telling themselves the same bedtime story they did back in 1972? That these companies are untouchable, that they'll grow forever, and that these crazy high valuations are totally justified. You know, it's like Warren Buffett said, one of the biggest challenges in investing is our tendency to just forget the lessons of the past. We're looking at a top-heavy market, we're seeing extreme valuations, and we have this unshakable belief in a few bulletproof companies. The parallels, they are really hard to ignore. So I guess the final question is for you. As we look at these echoes of the Nifty 50 in today's Magnificent Seven, are we once again whispering those 4 most expensive words in investing? Is this time really different?